So this is lesson 2, and here we're just looking at profit. Now I've given loads of lectures on profit, and we're going to do this in 2 parts. But basically all profit is total revenue minus total cost is equal to profit. Now students always ask, well, what the hell is total revenue? All total revenue is the price of the good times the quantity of how many of those goods that you actually sell. And at the same time, we also have a thing called total contribution. Contribution is selling price minus variable cost, right? And then you multiply all of that by quantity on there. So total revenue is price times quantity. Total contribution is selling price minus variable cost times quantity. Profit is equal to, there are 4 things we need to know if we need to be able to work out profit on the exam paper. It is selling price, quantity, variable costs and fixed costs. And the problem arises sometimes because it's quite hard to say what variable costs are. To keep it really, really simple, I always just say variable costs are equal to the raw materials. But variable costs could be anything which is taken into account in the production of that good or service. So it could also be wages if it's paid per hour. It's also the power to make the product. So if you have a restaurant, it will be the actual raw materials in terms of the food, but if your restaurant's really busy and you've got to hire an extra staff, then the staff would also be a variable cost as well, and also the gas to make the food on there. So that is variable costs. Fixed costs is anything or cost that you have to pay all of the time. So even if you sell no goods at all, you still have to pay those costs. Then when we go on to do break-even analysis, right, we have a nice easy fixed cost line goes from there, and those are your fixed costs. Now if you sell no products at all, so you've got revenue there, cost there, quantity here. If you sell no products at all, then clearly your loss is going to be, say that is £30,000, £30,000 if your fixed costs come to £30,000. So your fixed costs are rent, business rates, salaries, marketing expenses, lighting, heating, administration, costs that you must pay out all of the time. So there we go. On here we have selling price, variable cost, etc. So on this case here, imagine if you sell 10 products. So on this case, therefore, your sales revenue will be 10 times 10, which would be 100. Okay, so that will be your sales revenue. Put it all the way down there. Your variable cost will be 10 times 5, which is 50. Now to work out the total contribution, we do selling price minus variable costs. The quantity here is 10, by the way. Selling price minus variable cost, which is 5. 5 times 10 is 50, total contribution. So if we know that the total contribution is also £50, and we know that the profit is 20 quid, then we must know, therefore we must know that the fixed cost here must be 30 quid. Now the reason why I give you that quick little example on there is examiners are quite keen on this sort of idea. To obviously work out profit becomes very, very simple after a bit. You just go, I need those 4 things, I multiply them all out and I can work out profit. So they might give you they might give you the total contribution and then the profits, and the difference between the two will be your fixed costs from there. Okay? Okay, this is lesson 2, and we're still looking at profit. Remember, profit is sales revenue, which is price times quantity, selling price times quantity, variable costs, which is variable costs times quantity. That will give us the gross profit. Then off that we take off our fixed costs. We also take off depreciation, which is if you buy a fixed asset, something that lasts for more than a year, that will depreciate in value over the whole year. We take that off as well, and that gives us net profit, or what we also call operating profit. That income statement there, I call it a profit and loss account, but it's really called an income statement. That income statement will then give us a gross profit margin, a net profit margin, and a return on capital employed. The gross profit margin is gross profit divided by sales revenue times 100. The net profit margin is net profit margin, which is equal to net profit divided by sales revenue times 100. And then finally we also have return on capital employed, and return on capital employed is net profit divided by capital invested, and capital invested is non-current liabilities plus total equity times 100, and that will also give us return on capital employed. Now if we look at those 3 ratios, that will tell us a story about profitability. The most important ratio you can have is net profit divided by capital invested, because it shows us how much money we're making from how much has been invested in that business. Non-current liabilities are loans, and total equity is shares. Now, you probably know that all bigger businesses will probably get the money from long-term loans or shares. So that is a choice on there. So that is profit. Thank you.